Okay, students, at the last video, we ended at contingent liabilities, so let me start with those. Now, you see the definition here. Contingent liabilities are potential liabilities that arise as a result of past transactions or events, but their ultimate resolution depends or is contingent on a future event. Contingent liabilities differ from other liabilities discussed in this chapter because their dependence on a future event introduces a great deal of uncertainty. Now, let me explain that. Let's go back to the definition of a liability. And that is, it arises from a past event or transaction, and contingent liabilities, before they can even be considered contingent liabilities, must arise from a past event or transaction. They are present obligations, and contingent liabilities must be some potential present obligation, and they are going to require a future sacrifice. And with contingent liabilities, the requirement of a future sacrifice is dependent upon the outcome of something that is as yet unknown. Okay? So again, you see that definition right here. And so I'm not going to read it again. But what are examples of contingent liabilities that might help you understand that? And let's say, for example, that you decide to open a restaurant. And by the way, do you know how to make a small fortune in the restaurant business? Well, the answer is you start with a large fortune and then open a restaurant. And you can turn that large fortune into a small fortune in most cases. Anyway, most of you aren't going to laugh at my joke, but that one hopefully illustrates a point of the risk associated with business, especially the restaurant business. But anyway, let's move on. So you decide to open a restaurant, and I think if we really thought about it long enough and hard enough, we might all agree that if you open a restaurant and you serve enough meals to enough people over a long enough period of time, there is going to be someone that eats in your restaurant and then gets sick and then claims that you are responsible or your food is responsible for making them sick. And you may wind up having to pay some doctor bills for that person, maybe a little bit of some sort of damages to them. And so I think we could all agree, yeah, if you serve enough meals to enough people, somebody is eventually going to claim that. Whether it's true or not, doesn't matter. And so when you open your restaurant, you might decide, okay, let me set up a contingent liability to handle that. Now, would that be a properly recorded contingent liability? Well, to answer that, we need to go back to the definition of liability. So, does that arise from a past event or transaction? The answer is no. No one has gotten sick and claimed your food made them sick. So, we can stop there. We cannot recognize something like that as a contingent liability because it doesn't result from a past event or transaction. Now, let's say that someone claims that someone has claimed that they ate at your restaurant, they got sick, it was your food that made them sick, and they're threatening to sue you. Now, does that represent a contingent liability? Well, the answer is yeah, probably. It does arise from a past event or transaction. There is a possible obligation there, and it may require a future sacrifice. So it meets the definition of a contingent liability. Now, with contingent liabilities, there are three possible ways we may have to deal with those in the financial statements. And so those three ways are set out down here in the characteristics that cause it to fall into which category. Now, the three things we may have to do is number one, nothing, not even mention it. Another possibility is we don't record a liability, but we do have to disclose it. We have to describe in the financial statement notes what happened and what we think is likely to be the outcome. And then another third possibility is we may have to record a liability. Now, which of these three categories it falls into depends upon two things. Number one, how likely is the liability? In other words, how likely is it that we are actually going to be liable and incur some liability? Well, three possibilities here. I'll start at the bottom. If the answer is it's a remote possibility, in other words, it could happen, but it just doesn't seem to make sense. You know, they ate in our restaurant, they claim they got sick, but the claim that they made about getting sick was for muscle soreness. And that doesn't result from eating food. If they were claiming food poisoning symptoms, that might make sense, but no, we think there is a remote chance. So in that case, you don't have to do anything. You do not even have to prepare a disclosure note. Now, second is reasonably possible. And what does reasonably possible mean? Well, you look and say, we think it probably won't happen, but it's certainly possible it could. And so if you're looking for percentages, there's nothing set out in the guidance in the literature, but I guess one rule of thumb might be to take thirds. If you think the probability is 33% or less, then you classify it as remote and you don't have to do anything. Now, if you come up and say, well, it's more than 33%, but less than, say, 65%. Now, I would throw out more a rule of 25-75. Whereas if it's 25% or less likely to happen, now obviously we're making those numbers up, but they've got to come from somewhere. 25% or less likely to happen, then I'd classify it as remote and do nothing. If it's more than 25% but less than 75% probable, then I'd say that's reasonably possible. And when liability is reasonably possible, you must disclose it, but you do not recognize a liability. So you explain the situation, you explain what gives rise to this possible liability, what the circumstances are, and you disclose it. Now, most lawsuits are treated in that way, but I'll come back to that in a minute. So now the third possible category is probable. And while no percentage is associated with it, which makes sense because these percentages are just something we make up, but probable, according to US GAAP, means it's probably going to happen. Now, International GAAP defines probable as more likely than not, or 51%. US GAAP says probable means likely to occur. In other words, it's probably going to happen. And so I would say that's 75% or more. If you think it's 75% chance or better, then I would throw it into the probable category. Now, if it goes into the probable category, there are two possibilities. You might have to record a liability and disclose it, or you may only have to disclose it. Now, the determination there comes to, can you reasonably estimate the amount of the liability? Okay? Now, if you can reasonably estimate the amount of liability and it's probable that it will occur, then you record a liability and estimate the loss. Now, a good example where that occurs would be warranties. You sell a product that has a warranty, probability is high. It's probable that there are going to be some warranty claims. Now, can you reasonably estimate the amount of the warranty claims? Well, the answer is if that's a product you've been selling for a long time or making for a long time, yeah, you can go based on history and estimate how many warranty claims you will probably have and about how much those will cost you. And so in that case, you would record a liability and then also explain or disclose about that liability. Now, if you say, yes, it's probable we will have a loss, but we cannot reasonably estimate the amount, then you disclose it, you describe the situation in the financial statements, but you do not record a liability. Now, what if we say it is probable we'll have a loss, but we can only estimate the liability within a range? So we come up and say, well, something happened, whatever it is. Let's say warranty claims. We think there will be warranty claims. We just aren't sure how much. And so we think the warranty claims will be somewhere in the range between $200,000 and $300,000. So we think it will be somewhere between $200,000 and $300,000 in claims, but we really can't reasonably estimate how much closer than that, and any amount within that range is equally likely to occur. So the question then becomes, what do we do? Well, the answer is we recognize a liability based on that estimate. Now, then the next question is, what amount do we record? Do we record the bottom of the estimate, 200,000? Do we record the top of the estimate, 300,000? Or do we record, say, the middle amount, $250,000? Well, here again, U.S. GAAP and International GAAP differ. U.S. GAAP, the answer is you record the bottom of the range. So we would set up a liability for $200,000 in the example I gave. And you see the entry that would be there, debit to some expense that explains the liability, in our case, warranty expense, and credit warranties payable or something like that. Usually wouldn't be accounts payable, but some payable account. It would be something payable. Now, you may be wondering, why do we go with the bottom amount instead of the middle or the top? The answer is that the FASB looked at it and said, we don't want to get a situation where you record an expense in 1 year. Let's say we record $300,000 in liability for the warranty claim this year. And let's say it's 2 years from now, we actually wind up where the warranties end and we know how much we pay. And so we'd set up the top amount of our estimate, $300,000, and let's say it works out that it's $210,000 in warranty claims. So it was within our range. Well, what do we do 2 years from now? Do we go back and amend our financial statements for this year? Well, the answer is no. That's a change in estimate, and we don't go back and restate previously issued financial statements for that. So what do we do 2 years from now? Do we recognize a gain as a result of that? Well, that's kind of misleading too, because we didn't have a gain. So the FASB came up and said, we would rather have to recognize more expense later than show a gain that really didn't exist. So that's why the FASB decided that you would record the bottom of the range. Now, for the international GAAP, under IFRS, you recognize the midpoint of the estimate. Okay, our time is up on this video. I'll stop there and pick up with the next video.